the Social Security Tax Torpedo and how it could affect you, especially if you are in the middle to lower income stream. This is a big deal, man. A big deal. And it will, I'm just going to show you again. I've done it before, used the whiteboard. I've done it on a few other occasions on YouTube, but now I'm going to show you this article from these professors in the Journal for Financial Planning. So this is, I think it's date May, I think it's October 2018. I can't remember, May 2018. Understanding the Tax Torpedo and its implications, from Bill Reichenstein over at Baylor and Bill Meyer, who runs a software firm called Social Security Solutions, Inc. I've been reading Reichenstein for a long time. I'm a fan of Reichenstein and Meyer have written just a ton of articles on Social Security, so I'm a fan of both of them. All right, so the executive summary. The tax torpedo refers to the sharp rise and then sharp fall in the marginal tax rates caused by the taxation of Social Security benefits. For many middle-income households, this torpedo causes their marginal tax rates within a wide range of income to be 150% or 185% of their tax bracket. By the way, you see my good buddy there, Miss Betsy, the cow, or the longhorn. I think it's a cow. She's sniffing my hair. Many middle-income retirees can have a federal alone marginal tax rate of 40.7% in 2018. If we return to the 2017 tax rates, which is before the Trump tax bill, the marginal rate could be 46.25%, and we'll prove it to you. This paper provides income ranges in 2018 within which the tax torpedo will likely apply for singles, widows, married filing jointly as well, and married filing separately. Examples illustrate how singles and couples younger than age 70 may be able to reduce the adverse effects of the tax torpedo and thus extend the longevity of their portfolio by delaying taking Social Security till 70. It also explains how singles and couples already subject to RMDs, required minimum distributions, may be able to reduce the adverse effects of the tax torpedo by using Roth conversions. Someone should have written a book about that. Oh, your old buddy Josh did. All right, so let's go down. This paper explains the tax torpedo, which refers to the sharp rise and then sharp fall in marginal tax rates caused by the taxation of Social Security benefits. For many minutes, we already talked about this, so let's keep going. Examples shared in this paper illustrate how middle-income retirees in their 60s can reduce the adverse effects of the tax torpedo and thus extend the longevity of their financial portfolio by delaying Social Security benefits until 70. The key insight is that provisional income, the measure of income used to calculate the taxable portion of Social Security benefits, includes all withdrawals from tax-deferred accounts, which we'll forever call TDAs, like a 401k, but includes only half of Social Security income. Therefore, by delaying Social Security, a household may be able to increase Social Security benefits by $20,000 and decrease withdrawals from TDAs by an equal amount. So if you delay Social, our Social Security benefits increase, our withdrawals from our tax-deferred accounts decreases. This would cause provisional income, in this case, if you're going to do it for a $20,000 Social Security benefit, to decrease by $10,000, which could substantially decrease the taxable portion of your Social Security and other income taxes. The final section explains how households that are already taking RMDs may be able to use Roth conversions to reduce the long-term adverse consequences of the tax torpedo and thus lengthen the longevity of the portfolio. The key insight is that households with incomes that are beyond the end of the torpedo can use Roth conversions to convert pre-tax dollars and TDAs, tax-deferred accounts, to after-tax dollars at the sharply lower marginal rates that exist after the end of the tax torpedo. Such Roth conversions for 1 or more years can reduce or possibly eliminate future RMDs that would be taxed at the marginal rate of 40%. All right, let's keep going down. We're not going to talk about the research. All right. Rules affecting the taxation of Social Security benefits. There's a lot of good info here. We're not going to focus on it too much, but certainly if you're going to read this, you definitely want to understand the rules. I've talked about it a million times. But just remember, modified adjusted gross income includes everything in gross income except the taxable portion of Social Security. It adds all these items from page 1 of Form 1040 in the 2017 to it's basically total income. Now, if you go through this, you're like, oh, can he just say total income? And he doesn't. He says modified adjusted gross income. So we're going to use that as your income. All right. It's not your AGI. It's your income before you take your standard deduction. So I'm just going to say total income before Social Security. So remember, modified adjusted gross income is your total income except your Social Security. And that's what we're going to use. I hope that makes sense. He makes it harder to understand than I like. But anyway, let's keep going down. What is a tax torpedo? Well, we already talked about that. The tax torpedo is caused by the taxation of Social Security benefits. A marginal tax rate is the additional taxes paid on each additional dollar of income. The U.S. has a progressive tax rate structure. The idea behind a progressive tax rate structure is that a taxpayer's marginal rate should be low, possibly zero, at low income levels. But as income rises, the more taxes you'll pay. In general, the income of higher income households will be too high to avoid paying taxes on less than 85% of a Social Security benefit. So let's consider two individuals who receive relatively low and relatively high levels of Social Security. The examples both below will show in both cases that the tax or torpedo applies to middle income taxpayers. All right. So consider Tom, a single retiree who is at least 65 years of age in 2018. He'll receive a relatively low $12,000 a year in Social Security benefits. Because middle income households should not hold tax-exempt bonds, assume Tom does not hold any tax-exempt bonds. Notice how I highlighted that, I bolded it, and I made it italic. Middle income households should not hold any tax-exempt bonds. That's not just from your buddy Josh. That's from our PhD CFA professor at Baylor. I don't hold the tax-exempt bonds. So because it goes to your effect of your provisional income tax. Tom's provisional income consists of all his income that he has plus half of his Social Security benefits. So let's keep going down. All right. Table 1 presents his marginal tax rate for various levels of MAGI around the next dollar. So basically what's happening here is Tom's got $12,000 of Social Security, and he's going to have additionally up to $13,600 or up to $19,000. You can see these different tax rates. So basically, the income he has, we'll just say is RMDs or required distributions, or no, we can even just say tax deferred accounts. He's taking money from his tax deferred accounts in his 401k. So in this case, he's taking $0 to $13,600 of income from his IRA or 401k. His tax bracket thus is 0. Why? And he still has $12,000 of Social Security. So what we do is we take half his Social Security plus this right here, that's a provisional income, and he makes nothing. He has no marginal tax rate because his Social Security is not taxable, and then his $13,600 is a standard deduction. I hope that makes sense. However, once he has income, let's say $15,000, all right, $12,000 in Social Security, $15,000 of money coming out from an IRA, his tax bracket is still 10%. No big deal because, again, his taxable Social Security is nothing. He'll pay a little bit on his $15,000 of IRA distributions. All right, so in this case, he has $15,000 of IRA distributions, $12,000 of Social Security. Let's say he's now got $20,000 of IRA distributions. And it could be anything, $20,000 of income, doesn't matter. So now he's got $20,000 of IRA distributions plus $12,000 of Social Security. So he has $32,000 as his total income. What's his tax bracket? Well, it's only 10%, all right, because you take the $32,000, subtract out the standard deduction, and you get a 10% tax bracket. But with his taxable Social Security, it's going to be a 15% marginal tax rate, a 50% increase in taxation above and beyond what his tax bracket is, because a portion of his Social Security is now subject to tax on top of the $20,000 of taxes that income that he's got to pay tax on as well. Hope that makes sense. And now if you keep going up the stream here, you'll see, watch this. Here, at $30,000, so he has income. Again, it could come from anything. It could come from annuity, it could come from pension. It doesn't matter. We're just using $30,000 of IRA distribution. So he's only got $42,000 of total income. $30,000 from IRAs, $12,000 from Social Security. He is in a 12% tax bracket, but because of the tax torpedo, he's actually in a 65%, or I guess that's 66% higher tax bracket, because his marginal tax bracket here is 22.2%. because now he's got to pay tax on 85% of his Social Security, plus he's got to pay tax on $20,000 or $30,000 of IRA distributions. Whereas down here, he didn't have to pay tax on anything. So by just having more IRA distributions, it increases his taxes, his tax bracket, but it also increases his marginal tax rate significantly higher above what it would be if he didn't have that. Just there's no other way around that. So his tax bracket is 12%, but his marginal tax rate is $1.85. He pays $1.85 of income will be added to his bottom line for every dollar he makes. So basically, it just goes back to showing you, for every dollar he makes increase in income, $1.85 is being added to his taxable income. It's nuts. Yeah. So we talk about total income here is $25,000. So with a modified adjusted gross income at $13,600, again, we'll just assume that's everything from his IRA distributions plus his Social Security. His total income is $25,600. Total income $25,600, nothing. All right, but we scroll down here to total income of $30,000 plus $42,000 from $12,000 from Social Security, $30,000 from his IRA distributions. He's in a 22% tax bracket. It's crazy, man, crazy. All right, let's see my other notes. Yeah, like I said, professor makes it so hard. All right, so again, with a modified adjusted gross income, Tom's provisional income is $25,000. The first income threshold with a modified adjusted gross income between $19,000 and $28,000. So we see here is provisional. Right here is provisional income is 15% as a marginal tax rate. As we go up the stream, it goes from 15 to 18 to 22. And then once we get above and beyond $35,000, it drops to 12%. So it goes from 0 all the way up to 22, and then drops back to 12. It's crazy. It's freaking insane. Each dollar of income between $19,000 and $21,750 causes taxable income to rise by $1.50. He is in the 10% tax bracket, yet he will pay. His marginal tax rate is 15%. Thus, his federal income marginal tax is 15%. With a modified adjusted gross income of $21,750, his 2018 tax bracket is 12%. So each dollar of additional income between $21,750 and $28,750 will cause an extra 50 cents of taxable Social Security benefits, and then just what I just talked about. So in this case, with a modified adjusted gross income of $28,000, that'll put his provisional income at $34,000, which means each dollar of income causes another 85 cents of Social Security benefits to be taxable. So $1 of income, $1.85 of taxable income. It's freaking crazy. So let's keep going down. So, and Tom, of course, the middle income taxpayer. So here's Jane, a single retiree. She'll receive a relatively high $30,000 of Social Security benefits. So let's take a look now. So she's under 65, I presume. Yeah. No, it says who's at least 65 age. Okay. So here we got, because she has more Social Security benefits. So here again, because she got significantly more Social Security benefits, when she is at the $19,000 of modified adjusted gross income, so we got $19,000 plus her Social Security, she'll have, we'll say that's $50,000 of income. Her marginal tax rate is 22%, even though she's only in the 12% tax bracket. Here, when she has $35,000 of modified adjusted gross income, her tax bracket is 22%, but her marginal tax rate is 40.7%. Each dollar, let's keep going down here. With a modified adjusted gross income of $19,000, Jane's PIA is $34,000. Half of her Social Security, which is $15,000 in this case, plus $19,000 of modified adjusted gross income. Each dollar of modified adjusted gross income between $19,000 and roughly $44,000 causes another 85 cents of Social Security benefits to be taxed. Therefore, her marginal tax rate for each dollar of income is 22.2%. With a modified adjusted gross income of above $35,000, her tax bracket increases to 22%. So her marginal tax rate for each dollar of income between $34,500 and $43,706 is 40.7%. And then it drops again. And here's a tax torpedo for Jane. So, but when she has marginal taxable income between $0 and $10,000, there's no tax torpedo. When she has modified adjusted gross income between basically $10,000 and $20,000, she's at a 15% tax bracket. That's a pretty significant tax hit. When she has modified, because again, her tax bracket is only 10%. That's 50% increase. When she has modified adjusted gross income, basically $20,000 to $35,000, she's in a 12% tax bracket, but she's actually in a 22% marginal tax rate. When she has modified adjusted gross income of about $40,000 or so, she is in a 40% tax bracket, 22% tax bracket, but a 40% marginal tax rate. That's what the wealthy are paying, and she is not wealthy. She has $40,000 of modified adjusted gross income plus her $50,000 of Social Security, so she only has $90,000 of income. She's not freaking Mr. Burns. And yet once she gets up to $70,000 or more, her tax bracket drops back to 22%. It's crazy. And they talk about a married filing jointly couple as well, and it's the same premise. I've talked about this a million times a Sunday, so it's crazy. So let's just keep going down. And I'm not going to get into this because you can read the article, but the same thing happens, my friends. Based on the Tax Cut and Jobs Act, lower tax brackets scheduled for 2018 through 2025, more single taxpayers and married couples should be especially interested in withdrawal strategies that will help them minimize the amount of tax income of income that's subject to federal marginal tax rates exceeding 40%. So if you are single, regardless of what you think about the Trumpster, take advantage of the tax rates now, because between 2018 and 2025, when it sunsets, you are definitely going to want to preserve more of your taxable income because you're going to be made more come 2026 when the rates revert back to what they were. It is important to note that according to the TCJA, tax brackets and income range for each bracket will revert back to 2026 to 2017 levels. If that happens, the tax torpedo will become even more damaging because many singles and married couples would have a wide range of income that's taxed at the federal marginal tax rate of 46%. Jeez Louise. And again, I'm not going to go over this. You can see this. Let's just keep going down. We'll get to the conclusion here. For a married couple with $40,000 in annual Social Security benefits, there are no taxes on their first $21,733 of modified adjusted gross income. Again, that would be IRA distributions, we'll say. So if you got $40,000 Social Security and which is roughly $22,000 of IRA distributions, you pay no tax. None. However, if you have income between $24,000 and $57,000, your marginal tax rate is 185% of your tax bracket. So basically, just all it takes, look, from we'll just say $22,000, you don't pay any tax. You go to $25,000, that's $3,000 more. Your marginal tax bracket goes from 0 to 185. Your marginal tax rate goes from 0 to 185% of your tax bracket. Delaying Social Security may reduce taxation of Social Security benefits. The key insight is that provisional income includes all withdrawals from tax-deferred accounts, IRAs, 401ks, but only half of your Social Security benefits. Therefore, by delaying Social Security benefits, a household may be able to increase Social Security benefits by a given amount and decrease withdrawals from tax-deferred accounts by an equal amount. This substitution would cause your provisional income to decrease, which could substantially decrease the taxable portion of Social Security and thus your other taxes. Let me read it again. By delaying Social Security benefits, you may be able to increase your Social Security benefits by a given amount and thus decrease your withdrawals from your tax-deferred accounts by a similar amount. Social Security up here, withdrawals from tax-deferred accounts by the equal amount. The substitution would thus cause your provisional income to go down, which could substantially reduce your taxes. Yep, 100% agree. And they talk about all these different things here. Oh, I love this. This is a married couple example. Let's see, do we got two examples here? So we got married couple example. We got annual Social Security benefits of $31,000. They took it at $62,000. They took it at $70,000. Annual Social Security benefits of $52,000. They each have spendable amount of funds. They each have $75,000 of income that they can spend. And that's all we care about. You're spending money. But they got $31,000 of Social Security benefits and $48,000 of IRA withdrawals. So in this case, we're going to take $48,322 plus $31,680. So we have $80,000 of income here, right? But we're only going to have $75,000 of spending money because we have $5,000 of taxes. Here we have $75,000 of income, roughly, and $76,000 of income, but we're going to have $75,000 of spending money because we only pay $743 in taxes. So they are paying quintuple, these guys, what we're paying in taxes, and yet we're having the same net income because we delayed taking Social Security. Our provisional income is much, much lower, and our withdrawals from IRAs are much lower as well. Keep going down here. I think we got a single guy down here. Yeah, right on. So here we got, who's it? Jane takes Social Security at 62, or she takes that 70. Here she has, again, taxable spending money, $55,000 of net income. So here she has 21 to 39. Let's see, 21 plus 39. Here, 21 plus 39. Here she has $60,000 of gross income. Here she has 38 plus 18. 38 plus 18. $52,000 of gross income. 60, 52. They're both going to have $55,000. Wait, that's 38,000. Oops, I got it. Hold on just a second. There we go. I got to get rid of that. Oops, memory clear. Boink. What is it? Memory. All right, there we go. She has 38 plus 18. Yeah, 56,000. So she has $60,000 of gross income, $56,000 of gross income here. But because her Social Security is so high here, she's only going to pay $1,200 in taxes. Because her Social Security is so low here, she's going to pay $5,500 in taxes, 3 times the amount. They're both going to net $55,000 of spending income. But here, because she took Social Security later, she only ended a marginal tax rate of 22%. Here, because she took Social Security early, she's in a marginal tax rate of 40%. Let's just conclude this guy up. And so now we're going to talk about converting. So she could convert. I'm going on too long now, but just remember, you can convert. So what he talks about here is the ability to convert to Roth IRAs. From Table 2, she can convert $26,000 a year from tax deferred accounts to Roth to take her income to the top of the 22% tax bracket. This $26,800 would be taxed at 22% marginal tax rate. Each year she makes a Roth conversion would likely reduce the amount of her tax deferred accounts that would be taxed at 40.7% in the future. Alternatively, she might be more aggressive in converting funds to a Roth for fewer years. For example, in 2018, she could convert $101,000 to a Roth and have $26,000 taxed at 22% and $75,000 taxed at 24%. Each year she makes such a Roth conversion would likely reduce the amount of tax-deferred accounts that would be subject to a 40.7% marginal tax bracket. So she'd reduce her tax by about $4,000 a year. But be cautious. Although unusual, and it's not all that unusual, there's an important qualification. If she converts too much to a Roth, it might cause her to pay larger Medicare premiums. And so just keep that in mind. Increases in 2018 Medicare premiums occur at income thresholds $85,000, $107,000, $133,000, $160,000 for singles and twice that for couples. And you got to remember, if you pay more in income in 2018 or 2019 or 2020, you're going to pay more Medicare premiums in 2020, 2020. It's a 2-year lag, okay? All right, so that's all I want to talk about. A lot going on here. I'll put a link into the show notes, but the Tax Torpedo is big. Start converting now at 60, at 55. Start converting now, because if you're living on the lower end of the income spectrum, once you start having tax-deferred accounts for the RMDs and you're on Social Security, you're just going to hammer yourself from taxes. I hope this helps. As always, smash, and we'll see you next time.